Okay, well, we'll get started. Good afternoon, financial professionals. Dan Peterson here, president of E4 Insurance Services, welcoming you to the BREW, which stands for Building Relationships Every Week. Thanks for tuning in today, and for those of you joining the BREW for the first time, we'd like to start the BREWcast by celebrating today's National Day for September 16th. Today is National Guacamole Day. So everyone has their own way of making it. Be sure to enjoy some today. It's also National Play-Doh Day. Fun fact, Play-Doh was originally invented to be used as wallpaper cleaner. I remember as a 5-year-old eating some Play-Doh. Interesting experience. Then we have National Working Parents Day. 61% of families with children have both parents working outside the home, or in today's COVID world, many of them working inside the home in their jobs. So National Working Parents Day. Today on the BREW, we have our partners from Symetra, Brad Mills, who serves as our regional vice president, along with Doug Bowden, who serves as the director of advanced markets for Symetra. They'll be sharing a premium finance case study and other timely advanced sales solutions. Feel free to use the chat box to share your thoughts while our guest speakers are live. I'll be keeping an eye out for your questions so we can provide some real-time answers. Also, attendees are in a drawing for a prize and we'll be announcing the winner shortly, so stay tuned. Well, thanks for tuning in, and without further ado, Brad, welcome. The mic is yours.
Hey, thanks, Dan. I appreciate it, and it's always great to be with our friends from E4 Insurance Services, one of our very best partners. So I appreciate your business, and for the rest of the folks on the call, we got some good content for you. I have our advanced planning director, Doug Bowden, who also sits on our premium finance committee, going to take you through a couple options on our premium finance design. Real quick, I wanted to touch on our corporate philosophy: value, transparency, and sustainability. And the reason I'm doing so is because I think you'll see in our product build and our presentation, we really try to make sure that's on the forefront of what we talk about. We want to have a good value for the brokers, for the producers who sell our product with high targets, and also for the client that has low cost structure with built-in guarantees, not the hidden gotchas and leverage products that are out there. So we have a good value. We have a transparent product with a low cost chassis and no multipliers that are non-guaranteed, stuff of that nature. So as you can see, we have guaranteed UL, term $1.5 million and up will be priced very effectively. Protector IUL with built-in guarantees past life expectancy with good cash value buildup and high targets. And we'll focus on the accumulation product, very transparent, low-cost structure that has good cash value buildup and can play well in this premium finance space. So without further ado, really, I wanted to kick this over to Doug. And really what we're seeing at Symetra now on a lot of the big cases are these premium finance designs. Just in the world we're living in, kind of hard to stroke that big 6-figure check. And with interest rates where they are in the high 2s, you can get some arbitrage on the loan rate versus basically what you earn in the index portfolio. But Doug, we'll talk more on that, and we'll take it from there. Thank you.
All right. Thank you, Brad. So let's talk a little bit about premium financing. And what I really want you to get out of this is, where we're at here at Symetra in doing business with us in the premium financing space, and how our product looks in a premium financing example within there. And then I'll just touch on some guidelines to make sure you further know where we're going to be at when we do work on a case together to do that. So we all know the premium financing space. As Brad said, interest rates are extremely low today. The 12-month LIBOR, when I looked yesterday, it was about 40 basis points. At a spread to that of 185 to a couple hundred basis points. And those are pretty attractive rates, depending on, which lender or lenders you may be working with or want to bring a case to underwrite that loan. But with the attractiveness of those rates, it really comes down to not the free insurance, but it comes down to those who do have a need for a significant amount of insurance. and they simply understand leverage, but yet they don't want to liquidate assets, sell off assets, to fund a premium of that size. And they also, believe it or not, yes, still may have a gifting issue in today's exclusion environment, even though that's quite high. Maybe they want to preserve it for other assets to get a step up in basis. So maybe it makes sense to finance and only have really that loan interest out of pocket as the short-term cost, we'll call it, to minimize any gifts if we're using irrevocable trusts in particular designs out there. So what makes Symetra accumulator IUL and premium financing a good match here is really the product features in there. If you're not familiar with our product, all the bells and whistles of death benefit options, level options, increasing return of premium, help in the designs and the efficiency within a design of our product. We also have the surrender value enhancement rider, which is basically a modification of the surrender charge structure. So you have higher early cash values in the first 5 years than you would without the rider. And the rider is very well designed, and I will show a slide later on in here on what the difference looks like with the rider and without the rider for collateral purposes in a financing scenario. But anyway, back to the rider, one-time charge of $500, that's it for the cost of the rider to put on there. And then we have if you will, a real good design where we don't have a cliff at the end of the 5-year period. So the cash surrender value of the policy looks very tiny once that surrender value enhancement wears off at the end of the 5th year in there. We also have the flexibility of supplemental insurance coverage, which is basically your no-load term design, which can be added in for efficiency as to what you're doing within your design. And we have a premium deposit account currently crediting 2%, guaranteed at 1%. In there, that could be very useful. If somebody has a $200,000 or $300,000 premium a year, but yet maybe they want to borrow a larger lump sum to put in the PDA account to get more efficiency in that interest rate that the lender would provide. And of course, standard or preferred loans, we certainly have standard, which are the fixed loans within there. And I'm going to show you an example where we use a withdrawal in here and not a loan to repay the loan. So our standard, our fixed scenario at 4%, zero cost after the 9th, 10th year within there. And then of course, preferred loans where the preferred rate is at 5.5% in our model. So either one, preference, risk, all those are unique. So those are the neat product features that we have that make our product fit really well with premium financing in most scenarios. Let's just look at a real quick example here where I'm showing this at a 6% rate, crediting rate in the IUL illustration. So the point is I'm showing that we don't have to use max AG 49 rates in here to get this to work. So we're using a 48-year-old, and we are looking at a preferred risk class, not a super preferred risk class in our example, and we're max funding for 10 years in the example. Do we have to max fund for 10 years? No, but I'm just showing you what it looks like when we do. Maybe it's a 9-pay, maybe it's an 8-pay, but it all depends on design within there to maximum fund it. I'm starting out with an interest rate of 3.5%, and I'm increasing it up to 5.5% because interest rates obviously are going to change every year unless you're doing a fixed model, which some lenders offer within there. And of course, rates today would be lower than the 3.5% within there. But my point is that we're showing the loan interest paid out of pocket each year in here. And if you look in the middle of the page, you'll see the life insurance cash surrender value is $336,716 in the first year. So with that surrender value enhancement, we're pretty close to about 90% first year, 80% first year cash to premium in the model there. So our collateral requirement's $134,000 in our example. Again, this is just an example, and what our illustration software looks like. I'm just giving it 90% value, if you will, for the cash surrender value for the sake of the model instead of 100%. Because in reality, a lender will look at a 0% illustration at the end of 12 months or the 13th month to determine what that collateral requirement is going to be. So again, it's just a model within here. So generally, we're in the collateral pick, and again, based at 6%, we're in the collateral arena for 8 or 9 years based on this crediting rate that we're using within here. So it's not a forever process with that. And of course, what we're doing here is in year 16, and I'm purposely doing it in year 16, is we're showing you the withdrawal. We are literally taking a withdrawal out of the policy, and you can see that it has plenty of value still remaining in there in the 16th year. At the end of the 16th year, we have $2.6 million of cash value, again, at that 6% crediting rate, which makes it really efficient in there. And then you can see the policy has plenty of steam just running at 6%. So with some stress testing and so forth, this product works really well within the financing design. And of course, internal rates of return are really calculated on what's out of pocket, right? So if we're looking at the loan interest due, again, they might pay less loan interest, they might pay more loan interest. It just depends on the scenario, depends on the time frame, and what really happens each year. You can see in this scenario, we've elevated the loan interest a little bit, and based on the projected death benefit, the withdrawal out of the policy, you can see that we still got a really attractive IRR of 9.5%, 25 years out. And if we look another 10 years beyond that, we're still at 5.8% for the IRR, but at pre-tax equivalent at 35%, we still have a 9% internal rate of return. And of course, that's the attractiveness of premium financing, right? Loan interest versus that total premium, and with interest rates so low within the model, that's what makes Symetra Accumulator IUL such a strong product within these particular models. So let's take a quick look at what that surrender value enhancement looks like. I'm using that same model that I just had up, and you can see in the blue, if we did not have the surrender value enhancement, you can see what the additional collateral or total collateral amounts would be based on this scenario. So instead of the $134,000 in the first year based on our 90% of policy cash surrender value assumption, instead of the 134, we'd have to have an additional collateral call of 437,000. So very powerful, the surrender value enhancement rider. And notice the smooth curve as that surrender value enhancement, as the modification, if you will, of the surrender charge moves each year. And then by the time we get to year 6, it's pretty much equal. It just can't be equal because we had that little additional $500 charge in there, so it offsets the policy cash value by, by a little bit within there. But they're fairly close, and then you can see years 7, 8, and 9, everything looks pretty steady as far as not having a cliff where that collateral requirement tends to fall off. So really nice design there with that surrender value enhancement rider within there. And this is what I did for the design. I used $10 million. I actually used an option B, increasing death benefit in this scenario, not a return of premium, not that it matters, but in there. And you can see I am doing a pure withdrawal of the $4.3 million in year 16. And again, we're running it at a 6%, and I'm putting the surrender value enhancement on there. So the product runs really well at those low rates. Just to give you kind of a feel for where we're at with premium financing, we consider ourselves pretty easy to work with. And we don't have rigorous guidelines, just a few basics within here. And you can see on the screen that we'll look at cases up to age 70. We are looking for a minimum net worth of $5 million and an annual income of $200,000. But I highly encourage you to come and talk to us about your case ahead of time to make sure that we're good on the net worth, the income, and those net worth to income ratios that everybody likes to talk about with the amount that's borrowed out there. So within there. So we are obviously looking for a couple of years of tax returns to go along with any other submission requirements. And we have another little list of things that we need there, but not important for the moment. So the financing design guidelines, we have a list of lenders that we work with, not on our behalf, but these are as cases come in. If the lender's not on our list, then we'll work with the lender to make sure we're okay with that lender ahead of time if you have a specific one that's out there. But what we look for is the minimum loan commitment period of 3 years. Usually lenders are 3, 5, 7, some are 10, but most are about 5 years for the term. Loan interest paid out of pocket annually, of course. Increasing interest rates in the models, we can help you with those to do that. It's very important to show a little bit of stress testing in there to do that. And then, of course, the loan's 100% collateralized at all times. And that's, that's us working with the lender to make sure we're on board with their lending program. And then, of course, an exit strategy other than debt. And we would certainly work with you on that also. So other than that, I'm just going to kind of slow down a little bit because I just rambled right through that. And I want to make sure you are aware that we do have a library and a website with all kinds of other materials on there. And we can open it up for some questions, Dan.
Well, Doug, thanks for that. We've opened up the line, so if there's are any questions, I have some in the chat. A question that came from Shane Van Patten. Will Symetra allow the client to use their local community bank as the lender? Example, a farmer that is land rich, cash poor, and needs for the insurance, and the family has a relationship with the community bank for the last 3 generations.
Yeah, I mean, of course, we will certainly do our best to work with that. And my answer really is just get us involved as early as possible so we can start really our review of any documents the bank wants to use, collateral assignments, and give us a good chance to understand what their loan arrangement's going to be.
Very good. And Shane, I would also add from experience in this area that the challenge you'll have with community banks is will they understand the concept and allow for the collateral? There are banks that do specialize in this, and those lenders tend to be, have vetted this process, and you can slow down the process if a bank is not familiar with it, with the strategy and understanding what the risks are that they would have. So just an FYI that you can get into some training of banks that you may not want to get into. But I think the answer from Symetra's standpoint is sure they would allow it.
We'll work with it. Yep.
Or work with it. Yeah. Are there any other, do we have any other questions? So Doug, how much on your slide there, how much out of pocket? I noticed after the loan was paid off, they had over $2 million of cash surrender value left in the policy. What was the out of pocket on the interest that they ended up cumulatively paying there on the annual interest that was due?
So based on the model, of 3.5% increasing at 25 basis points each year, and then capping it at 5.5%, our total premium is $4.3 million, and we had out-of-pocket interest based on the model of 2.3.
So 2.3, and then when you pay off the loan, they have 2.6 in cash surrender value, but still with that 10 million, over a $10 million death benefit.
Yep.
Okay.
Yep.
Very good.
Yeah.
Okay. Do we have any other questions? All right. Hearing none. Today's winner, Doug, if you would pick a number between 1 and 50.
Number 11.
And Danielle, who do we have winning that? It's Steve Walker wins the card today. Steve, we'll be in touch with you via email. It's a Starbucks gift card. Be on the lookout for that card to come through from E4. And be
I
sure,
like number 11.
there you go, number 11. Steve was number 11 for North Dakota State Bison. Be sure to tune in next Wednesday for the BREW. We'll be having a discussion with Jason Jaffries of Prudential, and he'll be discussing the IRA max opportunities based on the Secure Act legislation. We're seeing some activity in that area. So thanks, friends. Happy September. Make it a great day. And thanks for joining us on the BREW.
Thank you.
Thank you. Thanks.